So we will now move forward to our next two sessions. Elad, please take the stage.
Thanks. Second. So thank you everyone for joining the session. Super excited to share eToro journey to FinOps. I'm Elad Gottfried, the Director of Production IT in eToro, and I'm going to discuss about what we're doing with the FinOps operation in eToro and a bit about our journey in eToro in the last few years. I may also disclose that we are also Cloud Team customers and working with them for their FinOps operation, and may I say that we are very happy customers. So a bit about the agenda. I'll discuss about eToro, our tech stack and infrastructure, what is the FinOps operation in eToro, cost management, cost mindset, cost tracking, and automation. So a bit about eToro and what exactly we are doing. So eToro is basically a trading platform, and it is the largest social trading network in the world with more than 20 million registered users. And not sure if everyone ever heard, but recently we announced that we are going to be a public company through a SPAC merger with the valuation of $10.4 billion, which is one of the biggest public companies that was announced this year. So it is a big milestone, and I really want to share the transformation also that we have done in the last year on this one. So I'll discuss a bit about what eToro is doing, about the product, and what is a bit unique about eToro social trading platform. So as I said, eToro is a real-time trading platform that allows to trade both cryptocurrency, CFDs, commodities, stocks, and we have more than 5,000 unique assets that we allow to trade in the platform. We also announced about a year ago that we offer a commission-free stock trading. So basically, you can just purchase through eToro an Apple stock without paying any commission. And we also support many types of cryptocurrency trading in our platform. You can buy Bitcoin, Ethereum, or any other cryptocurrency. We offer more than 30 unique crypto assets in our platform. And we are, I think, the biggest differentiator in eToro is basically the ability to do the social trading. And what is the social trading? Is basically the ability to copy people and also to discuss and share ideas about the trading portfolio or trading opportunities. We also offer a debit card, which eToro is going to announce this year. So basically, not only we allow people that are trading the platform to trade assets, we also allow them to send that money through a credit card. And also we provide a crypto wallet that you can also provide your crypto assets into a digital wallet that eToro provide for you, and you can actually purchase anything with Bitcoin or Ethereum or any other crypto assets that you hold on your wallet in eToro. So as I mentioned, we're a multi-assets trading. We offer many types of trading assets, and all the trading is done on real time. Basically, all our systems are real-time trading that offers to not only to purchase specific asset, but also the ability to copy people. And this is actually what's very unique about eToro. We're not only allowing to trade, but we also allow to copy specific people. Let's say you identify in eToro a specific trader that you think is a great trader, and you can see his portfolio and see that he's investing in stocks that you also want to invest, and you can see also his position and profit or loss. And you can basically take $10,000 and put on that investor, and basically whatever he will do will automatically be copied to your account. So basically he is becoming your money manager or your personal investor. So we have many people using this platform to copy other people. And specifically, we have the popular investor program that we have there many users that are holding many millions of assets of eToro customers. So a bit about eToro journey and what actually happened to eToro in the last few years. As you can see, the number of registered users has grown dramatically. And we're currently in a phase of what's called a hypergrowth. We had a huge demand of our services in the last few years. In the last year, I would say was pretty crazy. And we have a huge amount of people joining us. Also, you can see here the number of trades and number of registration done on our platform in the last 2 years. And as I said, we had dramatic growth in the platform. Which eventually caused us to create many more services in the cloud, and I will share a bit more about what this huge growth how it's related to the FinOps operation. So a bit about the tech stack in eToro. We have a very large tech stack. We have many services. And we're running currently in Azure Cloud and also a data center. We have many applications running for either DevOps and monitoring, and we have a big stack that we need to support. And a bit about the platform. We have hosted data centers that still available. We have 5 cloud regions that we are using. We're using only the Azure platform for 90% of our cloud usage. We have more than 300 services or microservices running in production. More than 750 databases holding more than 1 petabyte of data. And we have more than 3,000 servers running our entire production systems. A bit about our operating metrics and to understand the impact that we have on our infrastructure. So our daily metrics that we have more than 2 billion hits that we're getting to our platform each day. We're using more than 30 terabytes of network traffic each day. And we're saving more than 10 terabytes of application logs each day, and we're sending more than 30 million notifications to customers each day. So this is the growth that we experienced last year. As you can see, the number of concurrent users had 6 times growth from last year. And our APIs, that our main APIs that we are looking at, is the trading API login, and was increased by around more than 10 times from last year. Also, the number of logs indexed and the network traffic and notifications sent. So, as I said, we had a huge growth last year, and this had a huge impact also on our financial numbers in Azure. As you can see here, this is the cloud cost in the last 12 months. Without the number, I can say that we're spending many millions of dollars each year on Azure. And you can see here the big growth that we had during the last few months. I can say that we started actually working on the FinOps operation around December, and that was pretty much before our big growth. And we are very happy to started that before the big growth that we had, because if we haven't done that, I would say that we're spending many more millions of dollars on the cloud. So I want to share with you the big impact that we had on FinOps on our operation. So a bit about the transformation that we are currently in the last 2 years. We had a huge transformation in eToro to move to a more cloud-native solution. In the past, we were more a Windows shop or a .NET shop, and we started about 2 years ago moving to .NET Core, which allows us to basically move from Windows operating system to Linux, and also move from virtual machines to container, and move away from our custom build or orchestration to Kubernetes. And as everything is moving to the cloud, everything needs to be active and multi-region. So we made sure that all our architecture is also moving to an active. So it is a huge transformation that we had. And we need to support not only a single region, but multi-sites. And as we have a global reach around the globe, currently we need to support a few major regions, which is the US region, Asia region, EU region, and the UK specifically. Right now, most of our customers are located in Europe, but we're expanding a lot more to the US and Asia, and we want to support with a local presence there. And we want to make sure that all the customers will get the major focus around availability, performance, and of course, reliability. So a bit about the cost driver that we had in the last year, and also about the current growth that we are expecting. You can see here the number of microservices that we are running in production since 2019, and we had a linear growth in the number of microservices, and also we expect this to continue as we keep growing as a company and also increasing the number of developers. We are just in the last year, we almost doubled our engineering, and we are about to even double it again in the next year. So we expect this trend to continue. And regarding the second major cost driver, we started the Azure migration from our on-prem about 6 years ago. And basically around 70% of all our services are currently running in Azure. And we started moving to containers 2 years ago. And right now, 50% of all our Azure application is currently running on AKS, which is the managed Kubernetes in Azure. And the idea is to move most of our VMs to containers, as we see a huge benefits from the cost perspective. Not only there are many other improvements moving to containers, but in terms of cost, we see a huge benefits of moving to containers to save costs. And basically, we're currently at 50% and expecting to reach about 70% till the end of the year. So regarding our cost challenges, as I said, I think we started actually running a real FinOps operation about 6 months ago, where we started working with the cloud team to actually improve our cloud FinOps operation. And this is a part of the challenges that we faced around cost visibility, ability to track the cost changes, cost data analysis. We wanted to provide self-service to R&D. We didn't want to to be the only department that is in charge of cost. So we wanted to provide the R&D the ability to see the cost and control the cost, which I think is a big part of actually a grown FinOps operation. We wanted to provide budget owners inside R&D, as back then the IT and the DevOps was the main cost governor and mainly in charge of the cost. Finance was not part of the process. There was a lack of alignment with the cost and the business data. And there was a really hard time to understand what changed and when it changed and how it impacted the cost. We had challenges around cost forecasting, and we didn't have a proper way to reduce waste of unused resources. We didn't have the regular operation around it. So this is when we started understanding that we need to have a real FinOps operation, and started working with cloud team around those areas to improve it and see how to provide a much more mature FinOps operation in eToro. So I think that the first thing we started was around cost tags. I couldn't say more that cost tags is probably the most important thing in order to start understanding your data. So it's something that needs to be designed and needs to be designed for an easy change later. I can say that what we did was basically took a spreadsheet and connected it with some automation to Azure. And by that, we were able to provide an easy change of cost tags that were replicated to Azure through automation. We provided something called a resource unique ID that was represented in the Google spreadsheet. That this is where we provided people the ability to make changes to the tags, and basically we propagated all that to Azure. This actually allowed us to make many changes, like people that were changing teams and moving from one department, services moving from one department to another. It was very easy to change it and actually see it in the portal later. So I think it is a big thing to consider how to provide the cost tags and how to make it very accessible. And we started working on the cost center and cost analytics. We're using both the cost center in Azure and the Cloud Hero platform, which I will describe later, which is something that is very helpful for us to provide data to our budget owners. We want to understand how we handle spikes. Basically, from time to time, we see a big increase in resource utilization or resources cost spend, and we want to understand what happens. A clear cost reduction plans to provide actual and something we can share to finance and understand what cost are we reducing. The operation around reservation, I think this was a huge improvement for us, as we defined a clear policy around reservation when we're going to purchase more reservation and how we handle it. It is a big operation right now that saves us a lot of money. And around the cost optimization, how to optimize resources, unused resources, and basically create a clear life cycle that we not only handle it once, but also getting alerts and getting the proper automation around those areas. So we defined a clear cost roadmap with cost visibility. We defined the cost budget owners that we shared with our R&D group managers. And basically each group manager in eToro is becoming a budget owner and has the ability to see only his resources and see his spend. And this is done through the cloud management system, which we're using the Cloud Hero to show him some dashboard and action item. I'll elaborate on this in the next slides. The ability to automate the resource tags is super important to edit as part of the automation to make sure that every resources that is being provisioned is being done with the proper cost tags, and to make sure that no resources are being actually deployed without tags. The ability to provide custom dashboard to show the visibility, and the ability to provide clear cost planning, which we want to provide at each new project that our R&D is doing. The cost planning is part of the HLD design. It's super important to make sure that the developers themselves understand the cost of what they're going to move to production, and to make sure that they understand the impact of their change. So it's something very, very clear that we want to make sure that R&D is part of the cost mindset, and make sure that as part of each service that is going to production, there is a clear understanding of not only what is the resources that is needed, but how much they're actually costing. And also the cost forecasting, working with the finance department on the cost forecast to better understand what we're going to spend, how this is related to our business growth, how this is related to our user growth, and make sure that we provide finance a clear understanding of where the money is going. So this is a super important slide of actually showing the ROI of what the FinOps operation is doing. This is currently without the numbers, but it's clearly showing the trends of when we started running the FinOps operation and how much money we have saved. I think this is something that finance department is always looking to understand what is actually the ROI of the FinOps operation, and how much money we actually save by actually doing all the FinOps operation. A bit about the budget owners that, as I said, we are currently using a Cloud Hero platform to provide all of the R&D budget owners the ability to look at their resources. And the Cloud Hero provide here a pretty clear solution around visibility to resources. It allows to break down to many types of services, teams, components, subscriptions. And what we actually saw that was very beneficial is actually using the sunburst chart in order to understand the cost. And the sunburst is what you see on the drawing. It's actually a multi-dimensional dashboard that can allow to clearly see the cost of each element. You can drill down very quickly through the elements of the dashboard, and it allows a much better visibility to where the cost is going. Also understanding the highest cost resources and what was changed. So it's a dashboard that we built in order to get a first glance of what actually, where the cost is going, get the proper visibility. And we split the dashboard into three items. One is the general overview. The second one is actually the action items, understanding what you can actually do with the data, where you can save. So it's showing right now unused resources and underutilized compute that you can actually take action items. And another panel that will allow to drill down to cost troubleshooting. Many times we see that sometimes the cost is not clear, and you actually need to drill down into a specific resources in order to troubleshoot actually the cost and better understand what is the resources that created that growth. So it's also a great dashboard in order to show the drill down. So what we are doing around automation, which is a critical part around FinOps, the bigger investment that we're doing around automation is clearly saving us a lot of time and money. So this is part of the things that we're currently doing. We're getting alerts on growth, which is the big resources that is currently being provisioned in production. So we set a threshold that what is actually a big resources, and we're making sure that each time that a new big resource is deployed, we understand the reason. The people that deployed it actually understand the cost of this and understand that it actually something that can be reduced or anything that can change. Everything around tagging, as I said, must be fully automated, and this is like the major part of understanding your cost. So make sure that you deny people to deploy resources without any tags. Also around the reservation, this is a critical element to save money. So we automated part of this around the alerting. Right now, unfortunately, Azure still don't support an API for reservation replacement. But I hope they will support it in the future, and it will be fully automated. Around also disks that are unattached and disks that are reserved, we also doing an alert-based, and also right now we're currently doing the deletion manually in order to make sure that we reduce the risk there, because we want to make sure that we're not deleting something that is important. And also around underutilized resources, we also provide some automation in order to provide the reporting and alerting around those areas. And that's it. Just want to mention that we are hiring. We have many new positions in eToro, both in the DevOps and IT monitoring, and many positions around the IT and R&D. So you're welcome to send us your resume. And if you have any questions, feel free to ask.
As a matter of fact, you have two questions waiting for you. One from Alice, one from Shachal.
Where is, let me see. Where do I see the question?
Well,
in the chat.
In chat, but I can ask you, how many FinOps engineers do you have in eToro? What are your main FinOps KPIs?
Okay, so basically we don't have our own FinOps engineer. As I said, we're working with Cloud Team. They provide us with FinOps as a service. And Cloud Team has currently three people that is working with eToro. And the FinOps KPIs is basically around cost saving, which is our major KPIs. It's around the budget owners, how much the visibility that we provide them. And that's currently about it. We are in, as I said, we are in the process of doing adding much more automation and more ability to provide people the ability to see the cost on their own. I think one of the biggest benefit I see on the FinOps side is the sharing the mindset of the FinOps to everyone in the R&D to make sure that they understand the cost of their resources and can understand when can they save money and when can they change something in the design in order to make sure that it's much more efficient and also even save money.
And another question from Shachar Kedem. Hi, Elad, how do you measure which cost reduction is a result of FinOps operation, which is related to the changes within demand or usage? So
basically, we understand what the changes that we're doing. It's not trivial to understand, what exactly was part of something that was planned to be doing by the FinOps or not. But we try to we try to make sure that we provide some accurate estimation around it. We want to make sure that, if you have an underutilized VM, and this is something you actually worked with the one of the R&D groups in order to change it. This is something that we are currently allocating as part of the saving, but also a big part of that is reservation that we're doing. So we try to split it, but there is no real formula that we can actually provide here to actually see it. It's something that we're trying to keep track of the action items that we're doing, and basically add a cost tag to each one of the action items that we took. Basically, each action item had a cost saving, so we write it down, and this is what we calculate as part of the FinOps ROI.
More questions.
Hope that answered your question.
Okay. Thank you very much, Elad. We move forward now to our last but not least, our special guest, Chris Cochran. Go ahead, Chris.
All right, let's see. Well, very nice to be with you. Thanks to Cloud Team for having me. I think I might be the last thing that is separating you from your family, friends, and potentially a meal. So I'll try to be quick about my business. Let me just quickly start with some bona fides around Prosper Ops and who we are. We are a cloud financial management service for AWS Compute. We were founded in 2018, but before that, myself, I'm one of the co-founders of the company, and my two other co-founders worked for Rackspace, which is a large AWS managed service provider. And we started AWS's managed service business at Rackspace and got a chance to work with all the different tools and work with thousands of customers who are in various states of going to the cloud or optimizing once there. And ultimately, part of what Rackspace was trying to do for customers was to try to provide engineers armed with the best tools to go and deliver a variety of cost optimization solutions. And what we realized was that approach worked for a lot of the parts of the cost optimization equation. But when it came to using sort of the savings instruments, that there was a better way to do it than people with reports, and that was via an automation approach. And so we founded Prosper Ops under the premise that you could automate the use of these discount instruments in a way that would really maximize your savings and also minimize your commitment risk to the cloud provider. And today our company has about $300 million of compute spend in our customer base, where we manage commitment instruments on top of that. And we're an AWS partner and a member of the FinOps Foundation, et cetera. So let me first talk, some of the comments that Sam made and Elad made, I think made sense. So, we think about optimization in the broadest sense. In our parlance, we think about two major sections of the optimization problem: the engineering element and the financial element. Now, as Sam mentioned, he was talking about how much price optimization or rate optimization, if you're a member of the FinOps Foundation, I think that's the term that they use for it, can drive a very large bang for the buck. And that's our belief as well. And so, the average AWS customer, and your mileage may vary, has about 60% of their overall bill driving towards compute products, EC2, Fargate, and Lambda. And so if you're able to go after that bucket of cost and really optimize the rate and the pricing against it, you can make a massive dent in the overall AWS bill. So that's one of the main reasons we focus on sort of the right-hand side of this page, which is the financial universe. The other thing that I think Elad sort of spoke to is, I think one of the challenges that traditionally companies trying to use these instruments have had has been this relationship between the left-hand side of this page, the engineering work that should be happening and needs to happen, and then being able then to do the financial optimization work. And traditionally, you would think about those two activities as operating in sequence, where the engineering work happens first, and then once the engineering work is done completely, you can then move to financial optimization. And a big benefit of an optimization service or an automated optimization service on the financial side is that you can actually run these two activities in parallel. And so, look, financial optimization creates a big bang for the buck. You should do, though, many of the broadest set of optimization activities, many of which Sam and Elad spoke to. Our argument, though, is if you can run those two activities in parallel, you can really maximize the overall outcome from your organization. But this is hard. And the reason financial management and financial optimization ends up being very hard is because your usage ends up being very elastic by design. That's obviously what the providers want. But when they offer you these commitment and these savings instruments off the shelf, they are by nature inelastic commitments. So you're immediately in this contradiction where you have this potentially volatile and unforecastable elastic usage, and then you've got to try to pair that with these inelastic commitments that generally come in 1 or 3 year terms. And generally, once you make that commitment, you have very little recourse to change the commitment if your future conditions change, and that creates an inherent conflict. So what we generally see in the space with regards to the prospects we talk to, they will tend to arrive at Prosper Ops in one of two dimensions. Now, most prospects we talk to live on the left-hand side of this page, and they're interested in using these financial discount instruments. While AWS doesn't give you a mechanism to think about the risk of using these instruments, most people, sophisticated shops, will intuitively understand that these commitment instruments are rigid and they are long-term, and so they will hedge their bet and they will figure out some amount of commitment that they can safely make. In the FinOps Foundation, they survey their membership, and I think the data was that most people aspire to make commitments around 80% of their usage, but in reality, they only get up to about 60% of their usage, largely due to the fact that they understand these commitment instruments can be limiting if their situation changes. And so what ends up happening then is that a large portion of the overall usage stays priced at the on-demand rate, 40% using that FinOps Foundation metric. And so that obviously really cuts into the amount of savings that customers generate. And that is purely a function of the inelasticity of these commitment instruments. Now, on the other hand, we see a smaller number of prospects that come to us, and they tend to adopt a strategy where they very aggressively use these commitment instruments. And they almost, in some cases, try to match dollar for dollar their usage with their commitment instruments. But what inevitably happens that we see, whether it's business conditions, seasonality, or more likely engineering optimization work that is happening in the company that ultimately decreases the compute usage, those prospects will find themselves in an overcommitted state, which is what you see on the right-hand side of this page, where the sum total of the commitment obligation they have to AWS exceeds their actual compute usage. So they are upside down. And because these instruments tend to be inelastic, they have very little recourse to get themselves out of that overcommitted state, other than having their usage ramp back up, or the natural expiration of their commitment instruments where they can let those expire. So these are the situations that we see largely that sort of characterize the current state of cloud financial management today. Now, our approach to solving that problem is to say, how can you make these commitment instruments elastic as opposed to inelastic? And if you can make the commitment instruments more elastic, then they can mirror your elastic compute usage. And so a big part of the approach that we advocate and that we automate ultimately is this idea of making the commitment instruments as elastic as your compute usage, which means that you're not in a position where you've got to perfectly forecast your reservations and your commitments into the future and hope that your usage profile stays consistent with that assumption. Instead, because you can dynamically adapt your commitments and that they are elastic, you can basically just let your commitment portfolio adapt to changes in your usage profile. And we do that from an approach perspective with two AWS savings instruments that we sort of wrap together with our automation. We like to use AWS Compute Savings Plans. They are a great product that allows you to cover all of the different compute products, EC2, Lambda, and Fargate. And they are a global commitment that can float across regions. So, the compute savings plans give you a lot of horizontal flexibility to cover your needs. The problem with compute savings plans, though, is that they are a completely inelastic commitment. Once you make a certain dollar per hour commit to AWS for that 12 or 36 months, you are stuck in that commitment with zero recourse to change the commitment if your situation changes. So to offset that, we pair compute savings plans, and the compute savings plans you can see here on this chart in purple, but we pair that compute savings plan commitment with a layer of convertible reserved instances. And convertible reserved instances are actually a power user tool. We find most of the world doesn't really understand the power of convertible reserved instances, but they are actually a commitment that you can manage vertically. Your commitment can increase or decrease in concert with what's happening in your usage environment. And so it's the combination of a compute savings plan base shown here in purple with a convertible RI layer that we call a flex layer shown here in green that can collectively go and give you an elastic portfolio of commitment instruments that can mirror your usage, whether your usage is going up or whether your usage is going down. And a lot of what we try to drive our approach to deliver is to really go and cover 95% plus of the overall usage environment at all times with near perfect utilization. And if you can do that, you really can generate massive, massive discounts. And our target, which we think is sort of world-class, is about 40%, what we call an effective savings rate, which you can think of as an aggregate discount off of the on-demand rate across your global compute usage. So let me show you just some quick data, because I think this came up. I mean, some of the comments that Alice had and Shahar had were related to KPIs, and Amazon does not provide an ROI metric for the use of these financial instruments. And that's why actually we created this effective savings rate metric. And I'm showing you the scatter plot of prospects that we've talked to over time. And I'll just try to simplify this. On the horizontal axis, we're looking at $100,000 increments of monthly compute usage, starting at 0 on the left side of the axis, going up to about 600,000 per month of compute on the right side of the horizontal axis. So that's a proxy for scale. And in many ways, scale and sophistication of the optimization team end up being correlated. Not always, but many times they do. On the y-axis, or the vertical axis, is our ROI metric we call the effective savings rate. And as I mentioned, its goal takes into account how your coverage rate, which is, are you covering 100% of your compute environment, 10% of your compute environment, 60% of your environment, whatever it is, plus your utilization of your discount instruments. Are they perfectly utilized over the month period? Are they 98% utilized, 10% utilized, whatever it might be? Plus, what type of commitment instrument you're actually using. Are you using a 3-year instrument, a 1-year instrument? Are you running in one of AWS's at-scale regions like US East 1? Are you running in one of their niche regions like Tokyo? All of those things will change the discount that Amazon offers, whether you're running G4DN instances or M5 instances, all of which all give you a slightly different discount from AWS. All of those elements are taken into account to then answer the effective savings rate. When it's all said and done, what percent discount am I getting off of the on-demand rate across my global compute footprint? And so when you put this together in the scatter plot, you can see here in this red circle and this orange circle, a lot of companies that are either using these discount instruments so poorly or not at all that they effectively have a negative effective savings rate or a zero effective savings rate, meaning they're using the instruments so bad that instead of getting a discount, they are actually paying a premium to AWS, which sort of is crazy. But what really is interesting, and I suspect if you're on this webinar, you probably fall into this group, it's this yellow blurb in the middle. And this represents companies of large scale, varying levels of sophistication. And what we see in the data from the prospects we talk to is that even teams using great reporting tools, even with mature FinOps organizations, et cetera, have trouble generating world-class effective savings rates. And in fact, when we look at the data, you have to be in the 75th percentile or better to be getting an effective savings rate equal to or greater than about 20%. So the vast majority of companies, even at large scale, which you can see here on the right side of this page, are generating suboptimal effective savings rates with their use of these commitment instruments. And what ProsperOps seeks to do with our automation is to sort of use those commitment instruments together as sort of a single unified set of commitments to go and drive your effective savings rate from wherever you exist on this chart in the beginning towards this green line. And this green line represents an effective savings rate of 40%. And really our goal, and really what we think is world-class, whether you're using a tool like ProsperOps or not, but when you're able to generate 40% plus effective savings rates across your global compute footprint, you're in the 98th percentile or better of all AWS optimization shops. So that really is the upside. And so, going back to Sam's comment, when you can go and attack 60% of your AWS bill and generate discounts, aggregate discounts of 40% on that 60%, that's like a 24% overall reduction in the bill. So it's massive bang for the buck when you can go and drive up those discounts, and to do it in a way where you have a commitment portfolio that is generating very high returns, but is also elastic enough to accommodate either a planned or unplanned change in your environment. Now, let me just talk about the capability that's required to sort of pull this off. And so I'll just use ProsperOps as an example of how we think about the automation platform that's required to do this work. And I think Elad mentioned when he was talking about their experience on Azure today, that Azure lacks some of the elements to sort of pull this off. But in AWS has been very aggressive with their innovation around these discount instruments, as well as the API availability to control them dynamically. And so our system and what you would need to build ultimately to sort of pull off an approach like we just mentioned really involves three parts. The first part we tend to think about is data ingestion, and that comes from a variety of sources, both real time and delayed, whether it's Event Bridge for the sort of real time notifications, calls to the EC2 API. You can gather and build a fairly interesting real time profile about what's happening in the engineering environment, and then you can supplement that with slightly delayed information from Cost Explorer or the Kerr. So we ingest a lot of that information, constantly ingesting it, triggered by any time there is some state change that actually happens in the engineering environment. And then we run that through a massive optimization algorithm that collects all of that engineering telemetry, what instances are being spun up, which are being turned off, are they moving from R5s to R5As, whatever is happening, we want to understand that in real time. And then we bounce that picture of the engineering environment against their existing portfolio of compute savings plans and reserved instances. And we're really looking to try to understand in that optimization algorithm, is there an ability for us to increase the commitment level, to get some vertical, commitment expansion, to cover more of their usage environment and put, more of it subject to a discount? If usage has gone down, how much do we need to dynamically reduce the value of the commitment portfolio and able to bring the commitment portfolio back into a properly committed state, given that usage has gone down? Or if there's just shifting in the environment between one instance family of resources to another instance families, how do we go and find out what set of moves can we make that will go and increase the overall effective savings rate, and deterministically find, is there a way to increase the ESR? That's our acronym for effective savings rate. And then based on the ability to calculate that answer, we then go into an execution engine and make the API calls. And you would think that this element ends up being fairly straightforward, but actually when you're interacting with some of these AWS systems, there's a lot of complexity involved and a lot of orchestration you have to go and sort of set up. And our system, on any individual customer might be performing, tens, probably thousands, several thousands of API calls on any given month, based on sometimes tens of thousands of state changes that are being collected through the telemetry. And so that is sort of the three sort of elements of the platform that are sort of required to go and sort of manage this type of an operation. But obviously the benefit is that with an automation capability like this in place, your engineering teams are really able to go back and focus on the left-hand side of this page, which is sort of the engineering optimization activities. How do I re-architect the environment to make it as efficient as possible? And then sort of passively watching from the financial universe is this automated service that's collecting telemetry based on what's changing, and then programmatically optimizing the commitment portfolio to deliver high levels of ESR with a lot of flexibility. So I'm going to stop there because I think we're at near the time for my 20 minutes, but I'm happy to take questions on this approach and sort of the automation inherent. And this is really ProsperOps' mission, is to find ways to maximize your ESR, get you into that 98th percentile or better net of our charge, and do it in a way that gives you a lot of flexibility and elasticity in your commitment portfolio. I'll turn it over to Erez or answer any Q&A. Thanks so much.
Hi, everybody. Well, any questions? Feel free to write them down. And in the meantime, if anyone...
Maybe you want to open voice to everyone?
No, it would be a really big mess here. So, but to all of you that's still here, I'm sending my contacts in the chat. So if you want, if you need any other information and you want to meet, just ping me. Question, someone? Okay. So thank you very much, everyone who joined us in this meeting today. Thank you, Chris, Elad, Sam, and Itai, who really brought the knowledge into all of this community. As I mentioned before, if you have any other questions, feel free to contact me or any other people through LinkedIn. And thank you very much. Hope to see you soon. Bye-bye.
Thanks. Bye.
Bye.